I want to buy an investment property. Tell me, what is equity?
Equity is the amount available in your property, your existing property portfolio or your owner-occupied house that you have free to then leverage to purchase another property. A really good example of this is clients who don't have cash, but they are asset rich and they want 100% debt finance to be able to have no cash down to purchase your next investment property.
So if I've got no savings but have paid a big chunk of my home loan off,
Yes.
you're saying that I can buy an investment property?
Yes, and we count it the same because even though you may not have any savings, you may have ploughed all of your savings into your existing owner-occupied home, and we've built equity that way.
Fantastic. So I have done that. I've got a house that's valued at roughly $750. I've checked the internet. My home loan is now down to $300,000. So what does that mean? What do I have in equity? I've got $750, the loan's $300. So does that mean I've got $450,000?
No, we do apply a buffer, or a discount, and that's because no bank wants to lend you 100% of the value of a property.
Okay.
Yeah, that's just in case something goes wrong in the market and the property prices drop. They want to make sure that they have enough of a buffer to protect themselves there.
Okay, and so is that what lender's mortgage insurance is all about? Is that you usually have to have that 20% contribution? When I bought my house, I had to have a 20% deposit to avoid lender's mortgage insurance. Is that what you're referring to?
It is, so that's why we have lender's mortgage insurance if you have deposits of less than 20% of the purchase price. Lender's mortgage insurance is a protection against you defaulting on the loan, and it's taken out not by the bank that you have. The policy is actually put in place from a couple of providers like Helia and QBE. Those guys are independent companies and they're providing effectively an insurance policy from the market dropping in value and there being a shortfall.
Okay.
And that actually protects the bank, that doesn't protect you.
Okay, so put it simply is that I can't borrow 100% of what the house is valued at because the bank, it's just too risky for them.
Yeah.
But in saying that, if I leave a 20% buffer, so my house is worth $750, I've got a $300,000 loan. If I take the 20% off the $750, in my head it's roughly $600,000. 600 take 300 is $300,000. So I can use $300,000 as equity. Is that right for my investment? Okay, fantastic. Let's go off and buy an investment property.
When we're talking about the available equity, the other thing to consider is you don't necessarily have to have 20% deposit. We do have a number of investors who are very comfortable with paying lender's mortgage insurance because it allows them to get into the market sooner. And yes, they're using the equity in their existing property, but they may not. In this instance we've been talking about, they do have enough equity, but sometimes they won't and it'll be a little bit short. A number of clients are willing to pay lender's mortgage insurance, and so that cash out refinance is maybe 12% as opposed to the 20%, and that will still allow them to buy a property sooner.
Fantastic. Well, it looks like it's pretty easy to do. I just got to really speak to someone who's specialised and has got the expertise in this. So if I come and saw you, Lauren, you obviously give me some good guidance in relation to how I use my equity to buy that investment property.
Always happy to help.